Ciao. We've reached a crossroads. Today, we aren't just talking about numbers. We're talking about a collision between the great 2026 renewal, a cooling rental market, and a geopolitical oil shock. Whether you own, you're looking to buy, or you're currently renting in the GTA, the wait and see game has become a high-stakes gamble. This episode is your playbook to protecting your cash flow before the spring market and your rent shifts again. The Bank of Canada held the overnight rate at 2.25%. This is officially the neutral zone. Inflation actually dropped to 1.8% in February, before the Iran war began. Governor Macklem is in a patient but vigilant mode. For consumers, this means the massive rate hikes of the past are over, but the relief of deep cuts is being held hostage by Middle East uncertainty. We are at a plateau. Your strategy should be based on this rate, not a dream of 1%. February was brutal. 84,000 jobs lost, specifically 100,000 full-time roles gone. AI is starting to hollow out entry-level positions. While this sounds like a recession warning, for real estate, it's a rate ceiling. The BoC cannot hike rates into a job loss bloodbath. If you've been worried about rates going higher, this job data is actually your safety net. It keeps the BoC's hands tied and protects your current borrowing costs from further spikes. February sales fell 1.3%, but don't let the headlines fool you. This was a weather-related dip due to the January record snowstorm. The second half of February showed a massive spike in activity. Sherry Cooper calls this a positive harbinger. Pent-up demand is a coiled spring. First-time buyers have waited years for this bottom in prices, now 18% off peak. If you wait for the perfect sunny day in April, you'll be bidding against 20 other people. For my tenants and my landlord partners, we need to look at the rental market through a lens of pocket-specific data. Nationally, vacancy is up to 3.1%, and average rents have technically trended down for 17 months, currently hovering around $2,030 for a one-bedroom, one-bath unit. This is driven by slowed immigration and a temporary surge in new supply finally hitting the market. For tenants, this is your window to look at the data before you renew. In some pockets, you have real negotiating power. However, it's a two-way street. I work with many landlords who are managing their own rising costs, and they are looking at the same data. If you are in a high-demand neighborhood or a building where the fair market rent is still climbing or holding firm, a guideline-compliant increase isn't just a number. It's a reflection of the localized value of that space. Landlords who follow the provincial guidelines and provide well-maintained housing are essential to our ecosystem. So whether you are a tenant looking for a deal or a landlord ensuring your investment remains viable, the advice is the same. Let the specific data for your street and your building guide the conversation. But be warned, with construction starts dropping sharply, the breathing room you see in the rental market in 2026 might be the last bit of leverage we see for quite some time. Risk management is number one. The war in Iran is the new uncertainty tax. Shipping disruptions in the Strait of Hormuz could push oil to $100 a barrel. This hits your pocketbook at the pump and keeps inflation fear alive in the bond market. This is why we weigh fixed versus variable. Current simulations show the 5-year fixed is the cheapest hypothetical cost going forward. If you value mental peace over potential gain, the set and forget mindset may be your best defense right now. 2026 is the year of the refi wave, defending your equity. Thousands of you are renewing mortgages taken out in the low rate era. Your payments will go up. For investors, if your property isn't significantly cash flow positive, this is the time for a portfolio audit. Don't wait until 30 days before renewal to talk to a qualified and capable mortgage broker and or financial advisor. We need to look at lengthening amortizations or restructuring now to protect your lifestyle and your bricks. Risk management isn't just for the wealthy, it's for everyone. Tenants, use your leverage. Buyers, watch the spring rebound. Homeowners, prepare for the renewal. The spring market is typically the busiest market in the cycle. So we are seeing renewed activity, a lot of movement in terms of buyers looking for their options and sellers adjusting prices in order to get the price that is fair for the market at this time. Mark your calendars. Unemployment data drops on April the 10th, and Q1 GDP is on or gets released on May 29th. I want to hear from you. Are you seeing rents drop in your area? Do you have a mortgage renewal looming? Are you retired and possibly thinking about right sizing? Comment below, like and share this with someone navigating a renewal or portfolio change. Let's build your wealth brick by brick. I'm Nico James-Bock, a broker with Keller Williams Empowered and founder of the CondoWiz group. Ciao for now.